And hello, everyone. Welcome to Options Talk, profiting in times of market volatility. It is October 8th, 6 p.m. Eastern Time. My name is Daniel, and I will be your moderator throughout this presentation. And it's going to be a very exciting one with lots of examples, lots of charts that we're going to be opening up, lots of ideas that we're going to go through today. But before we get into all of this, let me ask you guys, where are you calling in from? Who do we have in the room today? I myself am calling in from Montreal, from Canada, here from our beautiful office in downtown Montreal. But who else do we have? Please put your location into the Q&A box. Let's see. All right. So we have Ralph from Winnipeg. Hey, Ralph, how are you? I did see your email also a bit earlier today. How's it going? Who else do we have? So we have Ralph from Winnipeg. We have Jasmine from Chicago. Hey, Jasmine, how's it going? John from Greensville, South Carolina. Hey, John, how's it going? Steve from Los Angeles. Hey, Steve, how's it going over there? Gabriel from Northern Virginia. Jose from Sydney. Is this Sydney, Australia, or is this Sydney in Canada, in Nova Scotia? Please let us know. Freder- Art from Frederick in Maryland. Hey, how's it going? Not so great flying weather. All right. Well, who else do we have? Let's see. Okay. Josie says from Australia. Wow, that's a long time. That's far away. What time is it over there? It must be super early morning, I imagine. And Roberto from Montreal. Hey, Roberto. Ah, great. Nice to see somebody from Montreal as well. Perfect. Well, thank you guys so much for sharing your location. And Jose says it's 9 a.m. in Australia. Okay. All right. Well, good morning in this case. And Patrick says his chat is disabled. Yeah, Patrick, please put your location into the Q&A box, and please use the Q&A function to put your comments and questions. Okay. All right, so let's get into it. First off, this session is being recorded, and you can watch the recording shortly after this webinar at this page here, tradingindicators.com/alerts. I'm going to put this link also into the chat box just a bit later. So this session is being recorded. Should you need to drop off, no problem. You can always watch the recording. Also, a quick reminder that trading does contain a risk. Also, option trading does contain risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, or really anything based on historical price data, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies and setups discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, so with this out of the way, let me properly introduce ourselves. So as mentioned before, my name is Daniel. I'm the guy here on the left-hand side, and I am one of the founders of tradingindicators.com. So this has been quite a while ago now, more than 10 years ago. And over the years, as our name suggests, we have built thousands of trading indicators. But as the time progressed throughout our journey, we have also spread out. So we have built other trading tools. We've built fully automated trading strategies, and we've also, done a lot of work with options. And of course, this is why we are here today. Most of what we do is based on what's called technical analysis, which is basically a mathematical analysis of your price chart. We believe that fundamentals are and these days as almost immediately priced in. And by analyzing your price chart from a technical point of view, you will indirectly take into account these fundamental information as well. And of course, we also believe that trading can be simple. And in fact, trading is simple, but you need to know what to look for. And what we are looking for when it comes to options trading, we're going to share with you today. Also, guys, if you have any questions, please don't be shy. The more the merrier. Put your questions into the Q&A box. I'm going to look out for these questions as we proceed through this presentation. And now it's time to welcome our special guest today, which is Jim Kenny, the option professor. And Jim, are you there in the room? Can you hear me, Jim? Hey, Jim.
I am, and good to be here, guys. We're going to have a lot of good information to share, and I'm very excited.
Absolutely. Perfect. Yeah. Jim's going to come on in just a bit with his market review and some of the ideas that some of the, interesting setups that he sees in the market right now. But before we do, and just to break the ice a little bit, let me read the room a little bit. Let me see who do we have in the room besides the location. And for this, I'm gonna be opening up a little poll on in your Zoom window right now. Let me just get this in here just a second. And the first question I'm gonna ask you is, what is your experience trading options? How many years have you been trading options, if any? So please answer this on your screen. And I'm just interested, who do we have in the room today? All right, that's interesting. Okay, so a couple of users who haven't traded options at all, a few with less than a year, 1 to 3 year, quite a few. And then many of you have traded options for more than 5 years. Okay, that's interesting. Perfect. Great. Well, thank you so much for giving us this information. It's going to help us to, to cater to the needs, to the audience that we have today. All right, so that's that. But I'm going to move on with another question. Just bear with me, just to, just to break the ice a little bit. The next question is, let me just go here real quick. Where is my poll? Give me a second. Oops, if I can find it. Yeah, what is your objective? So if you have traded options, what is your trading objective when you use option? And we have different objectives here that you can choose from. For example, grow a small account into a large one, generate consistent income, potentially hedge your portfolio. What is your objective by doing so? I'm really curious. Okay, that's also interesting. Oh, wow. In fact, what I'm seeing right now is that about 80% or 75% use options to generate income. Okay, interesting. About 50% want to grow a small account into a larger account. Okay. And about 15% use options to hedge their portfolio. Oh, cool. Great. Well, that's great insight. Thank you so much, guys, also for sharing this information with us. Okay. And we have one more question. I promise you that's going to be the last one, is about which options strategies are you currently using or have you used in the past? And you can choose between buying options, selling options, or multi-leg strategies. Okay, so I'm curious too. Wow, okay, the vast majority are buying options, about 80%. That's interesting to see. 50% use multi-leg strategies, and about 25, 29, 30% sell options. Okay, great. Well, that's great insight. Thank you guys so much for sharing this information. Perfect. So, step number one, or item number one, as I should say, of our webinar today has been completed. But of course, you're not here to just answer questions. You're here to learn something. So, what can you expect from this webinar? Well, let me just quickly move this away. Perfect. Well, let's see what we have planned for today. I'm going to give a quick introduction of why you should consider option in the first place. Of course, this is some basic information, mainly geared to those who are trading the options for the first time, or perhaps who are not very experienced with trading options. Then we're going to kick it up a notch, and we're going to talk about what's going on right now in the markets. And Jim, the option professor, will share with us what he's watching right now, which potential trades he's in right now, and what might be some interesting ideas. So that's going to come up next. Then please stay tuned for this. I'm going to afford everyone here in the room a free options trade idea. So it's going to come up then. Then we're also going to have an exclusive offer for all the attendees in the room. And there'll be plenty of time for Q&A. Sounds good? All right, let's get into it. So why would you trade options? Well, let me start first by saying, hey, there are a million reasons why somebody may consider options. Yeah, you may generate income. We had many replies that say, hey, you use options to generate income on a steady basis. Yeah, great idea. Speculation, I think a great reason for trading options, especially if you buy options. These can be used for speculation. Perhaps you have one idea, you want to speculate on this idea, you want to do it in a way where your risk is limited. Absolutely. Some of you want to use options for finding stocks which have significant upside potential and want to trade accordingly. Absolutely. This goes hand in hand with speculation. Tax efficiency, depending on where you are in the world, depending on your jurisdictions, options trading may actually be more tax beneficial than trading outright stocks. Hedging, of course, to hedge your portfolio is also a way to use option. Of course, option trading is leveraged in most jurisdictions, and options If you want to take off leverage, we don't have to have we want the broker basically to subsidize or to loan you money for your trading. Well, options trading would be a candidate for this as well. So there are many different ways and reasons why you want to trade options. And of course, options trading also will give you lots of flexibility. All right, now let's back up just a little bit. I promise you, I know for those of you who have been trading options for a long time, I promise you this will not take long, just a few minutes. Now, in theory, what are options? Or not just in theory, what are options? Well, options are contracts, which basically give you the right to buy or sell an underlying, oftentimes a stock, at a certain price for a certain period of time. And you can do this via what we call call contracts and put contracts, call options or put options. Now, this is the theory because in practice, the very vast majority of options are not enforced. In fact, what you will do is when you trade with options, you will sell the options contract before its expiration. You will not insist on your right to buy or sell an underlying at a certain price. You will get rid of your options holding before the expiration. And the very vast majority of option trades are happening this way. So in this sense, option trades are tradable instruments. All right. And of course, if you look at options as tradable instruments, what becomes important is that we trade them at the right prices. For example, if you want to buy on options, what you want to do is you want to buy low and sell high, obviously. If you're selling options, you want to sell high and buy back low. And for this, understanding option pricing is very, very important. Now, what do I mean by this? Well, if we look at how option contracts are priced, we can look at two components, the intrinsic value and the extrinsic value, and both are added on top of each other. Now, the first one, intrinsic value, that's a very easy calculation. And basically, it's just the difference between the stock price of the underlying and the strike price of the options contract. It's super easy to figure out. The extrinsic value, however, this one depends on the market forces, on supply and demand. And if you want to split those apart, this is the remaining time in your options contract, the time until expiration, and what somebody refers to or may refer to as implied volatility. Okay? So these two components, one is very easy, very mechanical to calculate. The other one depends on market forces. Now just keep this in mind. Now let's say we want to buy an options contract, be it a call contract or a put contract, or perhaps both, depending on what your strategy is. And by the way, buying option contracts is great for speculation because it's risk limited. All you can lose in the history of mankind is just the options premium. If the stock doesn't go your way, well, all you can lose is this premium. If it goes your way, you may have significant upside potential. You can also use it for hedging. We're not going to cover this today. And as such, if you are buying options, you want to buy low and sell high. That's very basic trading, buy low and sell high. But it gets a bit more complicated with options because options are not just outright stock trades. There are other factors involved. And one such factor is the time component. Every options contract has an expiration date. Remember when I said options pricing down here, the extrinsic value, that's the remaining time until expiration. And if you want to buy low and sell high, you need to understand that as time progresses, as you're getting nearer to your expiration, your option contract will lose value. It's really a race against time. Or in other words, all else being equal, the value of an options contract decreases as time passes. Something to be that you need to be aware of. And as an option buyer, the longer the wait, the more the value of an option contract will decrease. Also, buying options is also a bet on increasing implied volatility. Now you're basically betting that implied volatility will go up. And if it goes up, the value of your options contract will go up as well. Or in other words, all else being equal, the value of an options contract increases as implied volatility increases. Let's keep this in mind. Now, for selling options, it's the exact opposite. Here, you are the provider of the options contract. You want to sell to somebody else. And I always think of this as us or me being an insurance company who is selling insurance contracts to individuals. Yeah, and I get a premium in return as an insurance company. This is great for income generation because you get this premium right away and you can keep the premium no matter what. Yeah. You can also use this for minimize the premium of an options contract that you may go long for. If you sell some options against that or to buy stocks at a discount. But what you should always understand is that this can, if done incorrectly, carry significant amounts of risk. And once again, I'm going to use the insurance analogy. Imagine you are an insurance company and you're selling me fire insurance. So I will collect the premium as the insurance company, but if the house burns down, I'm going to be on the hook of reimbursing the client or the buyer of my contract for the entire house that burned down. So there is significant risk involved. And if you sell options, of course, you want to sell high and buy back low. All right. Now, if you're selling options, you're betting on the passage of time. The more time elapses, the more value your options contract will lose. And that's good for us as sellers of options because we want to sell high and buy back low. So the lower the value of the options contract becomes, the better it will be. And of course, we know this because as time passes, the value of an option contract will decrease. Also, selling options is a typo. Selling options is a bet on decreasing volatility. If volatility goes down, the value of your options contract will also decrease. Now, having this all said, I don't want to be stuck in theory. We're going to look at charts in just a second. Regardless of what you do, whether you buy options or sell options, options trading is much more than just predicting where the price of the underlying will go, whether it will go up or down or perhaps stay sideways. Because when it comes to options trading, picking the right expiration, the right strike price, and the right contract in the first place is absolutely crucial. You could be completely right about the direction of the underlying. If you get the other factors wrong, if you, for example, buy when implied volatility was extremely high, even if the stock goes up, if it's a call contract, you may lose on this options trade. So getting these other factors right is absolutely important when it comes to options trading. Okay, now let's get practical. Now, I want to say one more thing before we proceed. If you feel overwhelmed right now by what I said, and perhaps I said in a somewhat confusing manner even, don't worry. At the end of this presentation, I'm gonna show you how you can get our options masterclass, which is 6 hours of options education led by the option professor. Is gonna come on here in just 1 second, completely for free. So please hold on for this. It's normally a $397 value. Today, you can get it for free. Now, before we get there, please stay tuned because now we are going to move on to the third part of this presentation, the market overview and some key stocks to watch. So Jim, my friend, are you there? And perhaps reintroduce yourself to our audience.
Sure. Hi, everybody. I'm Jim, the option professor. A little background, I'm Boston College grad, went to UCLA for some grad school activity, and I've been in the options industry one way or the other for decades and decades. I was well trained at the Chicago Board of Options Exchange. I've done seminars throughout the nation and Canada for decades, so I've taught thousands of people about options. So I'm going to share with you what I do and give you some of the ways I handle things. Again, the idea here today is to try to help you become a better options trader and also share my interpretations and hopefully give you a smoother path to better results. And that's basically what Trading Indicators does as well. We try to help you with information that'll help you get down the road a little bit better. Okay, let me share the screen here 1 moment, and we'll get right into it here. And I'll show you what are some of the things I've been focused on and some of the things that you could take a look at as well. Are we good with the share?
Yes, perfect. Go ahead.
Okay, I just wanted to show you IBM real quick because, we all are wondering when this thing will slow down, and there's no evidence of it in a lot of indicators. But, 300, back down to 285? Is it a reversion to the mean, to the red line, and then right back up again? It's possible, but it also might be an indicator that today was a little bit of a blow off. And, Thursday is sometimes a reversal day. So it wouldn't be bad if you had some gains to get up a little early tomorrow and keep an eye on them. Okay, that's all I was going to say, and give you a little insight on what some of these ones that have had a big run look like. All right, let's go over to the S&P. Let's get right into what's going on with the major markets. Major markets are obviously in a major uptrend. If you go back on the long-term graph, you can see all-time highs. You can also see that some of the moving averages are way underneath the price. 5-year, look at that, Now, again, if we were to get a pullback, a 5% pullback from here would take you towards what's 300 points, around 6,400, something like that. And a full Monty 10% would take you more towards those former highs. So if there was ever a correction, those would be the neighborhoods that I would be more interested in bringing in new money, as opposed to chasing this, which could be called exuberance. But again, the numbers being thrown around, what's bullish out there? You got government stimulus, you got the money supply on M2 going up, you've got earnings coming out that probably are going to be pretty good, and you got sentiment. This is like the most hated. The reason people hate the rally is this: when it went down like that, everyone sold out. Now, do you think everybody has gotten back in as much as they sold out? Of course not. And it's very frustrating to see it go up and up and up every day, and you still are under allocated. That's the long and short of what we're talking about when you hear it's a hated rally. Sentiment is still weak because people are just dying to see if we'll get a correction, because they totally got wiped out during this period here. Okay, so that's the story there. Let me give you a couple of indicators I keep an eye on. The VIX, and the VIX is right now on the 1-year graph here. It has resistance. I've been telling people if it gets above 20, this market is going to have a very significant drop. If it doesn't, it could keep going. As a matter of fact, if you look at the 1-month graph, this thing looks like it wants to possibly collapse. So like I say, if we come in tomorrow and the VIX is trading at 17 or higher, I would imagine that the market might be rolling over. If in fact it doesn't, and you start hearing the VIX at 15 or 18, I think this market could soar. It's really on a ledge, and I'm going to show you why that is. Kind of a one indicator deal, but it's pretty easy to work with. This is the percentage of stocks above the 200-day average. Now, if you know anything about moving averages, when they converge like that, something big is going to happen. And you ever heard of the McClellan oscillator? I just saw somebody named Harry Boxer put that on one of the seminars. At very flat. So again, it's kind of weird to have this stuff very flat when we're on all-time highs. So it's either going to be, in my view, a deal where this thing breaks out and goes to 70, with the amount of stocks getting above its 200-day average, getting bigger and bigger and bigger. And then the VIX drops under 15 and goes to 14 or 13. And maybe we're looking at 6,900 to 7,000 on the S&P by the end of the month. Or it's going to be a situation where this thing starts going down, the VIX breaks above 18 or 20, and we're getting that correction that everyone thought would be coming sometime in October and November. So I would put my alarm on, and I would keep an eye on things and maybe make some adjustments on things if you think you want to reduce risk and make sure you are hedging some of your stuff. All right, now key stock. Let me just go over a couple more things. It's all on all-time highs, guys. I mean, it's like obviously melt up city here. This is gold. Now, even gold's rolling over a little bit, right? So, like I say, the trees don't grow to the sky, which is an old German phrase, by the way. I don't know how to say it in German, but I heard that's the story. Anyway, you don't have to be a genius to figure out this thing is way done. And, the last time this gold, you see how it was just like that 200-day average thing? Very flat, very flat. And when very flat changes their mind, boom. So again, I'm looking for the stock market to either have a very big advance or to have a correction. And because the trends are still up, but again, this thing wasn't overbought when it blew off. So I don't know. But the bottom line is when you get a flat market, you can get a big move. And that's what's going on in gold. And again, gold's had a very big run here. And so it is trying to roll over a little bit here. If you're a short-term trader, you got your sell signal at 40.60. You made 15 bucks so far. But again, it's in an uptrend, so it could easily go right back to 4,100 on you. But it has made a big move. The US dollar, I'm going to tell you the two things. Well, there's three things that could mess up the bull market. Okay. Because we already know what's going to help the bull market. You know, the Fed easing, M2's going up. We got the stimulus BBB, big, beautiful bill, and we've got negative sentiment. So we know why it's going up. What could make it go down? Well, again, what could make it go down is interest rates on yields do not go down, but instead they go up. And this is the 10-year note. And I've been telling people that I don't like it until it breaks under this number here, which is the April low of 388 yield. If it breaks under 388 yield, you know you can go down to 3% over time right there. That's where they're thinking it's going. Okay. But I don't like this thing either. And this is called floating rate. I know I'm getting into a lot of stuff that you guys probably don't watch, but I'm telling you, I watch it. So that's why we're going to show you. This is floating rates. Okay, that means short-term loans to corporate lenders, borrowers. And you know, corporate spreads between corporates and treasuries are really tight. This thing looks like it wants to tank. And if this thing tanks, that means the corporate bond market and yields are not going the right way. So I don't worry about things that haven't happened, but I'm certainly aware of things that could happen, because if you're not, you're going to lose a lot of money. So the bottom line is I'm watching the interest rate picture. That could be a problem. The other thing that could be a problem is the value of the dollar. I've been telling people on my reports that I send out every week, the dollar has major support in the 96 to 98 range, and it's trying to break up. If it breaks up and jumps up to 100, 102, 103, that's not factored into the stock price as a stronger dollar. And if you want to look elsewhere, you can look at Europe, and you can see the euro looks like it has run out of steam a little bit as well. So there's your euro. Is this thing going to go all the way down to 112? And is the dollar going to have a big rally? That's not factored into stock prices. So you got rates in the dollar that could be problems, and inflation could be a problem. I don't know about you guys, but houses in my neighborhood are being sold for top dollar. And rents around are moving up, and my green fees at the golfing is going up. So I don't have a lot of discounting going on in my life, but if you do, God bless you. So I'm thinking the inflation, and of course the effect of the tariffs, they're just starting. So the bottom line is inflation could very easily go up, and then if that led to job losses, that is a game changer. Not happening right now, but if you don't look at where the puck might be going, you have to know where it is going, but you also have to give some parameters on where it might go to make sure that you're prepared. Okay, let me show you some things that I've been into that I'll show you three right off the bat, and I'll tell you why I like them, why I did them, and you can get a little flavor on how I operate. Okay, so here, this is, there's two times I'm interested in doing options. One is on what? A breakout, and when the other one is called reversion to the mean. I'm going to give you examples on both. Okay, this is a super micro, and last week I had all my averages converging, and it hit the gold, so that's a reversion to the mean, right? That's what a reversion means. You go from 65 down to the yellow line. That's a reversion. Okay, then it's turning up. RSI is turning up. When RSI breaks above 60, I'm going to probably make a lot of money on my calls. Why is that? Because that's when the acceleration phase happens. So again, I took my shot at the $50 calls for peanuts, and obviously they're worth more than peanuts today. But why did I do it? Because I had a reversion that told me the selling was done. Then I had the averages turn up that told me the trend's turning up. And then obviously this is a company that is in the heart of all the stuff going on here, right? And so that's why I took my shot, and that's why it's worked out pretty good. The other one that I thought looked pretty good was XYZ, which is Block. And again, same story. We came down to my reversion. We went up a little bit. I took my shot a little bit out of the money, and boom, they're spiking up pretty good. Last one I'm going to show you is PayPal, PYPL. And again, same story. First of all, this thing has been just consolidating forever, frustrating the heck out of everybody. And so again, there was a gap to be filled. So the options were dirt cheap, and I can see the board's going up, right? The board, what is this thing going to get left behind? What is this thing going down to $58 while the board's going up? And these people are all over what? They're all over crypto. They got their own stable coin already. So you take your shot when it's when the options are dirt cheap here. I didn't pay squat for the 70 calls, right? And that's what I like to do. I like to see if these things can come down on a reversion and then start turning up and then buying the breakout, or when I see something that might break out. It doesn't work every time, but I'm playing a game where you lose a buck or two if you're wrong, and you can make a heck of a lot of money if you catch a ride. And that's what we're doing. It's called risk capital. That's why I'm not a big fan of I saw on the thing, you guys, some of you are doing like 19 legs. This is all my opinion, by the way, but it's based on what? A lot of knowledge, right? So anyway, why don't I like these 19 leg trades? Because I don't know how you're going to make money on them, and you're using risk capital. And if you're wrong on some of these risk trades, you can lose a lot while you weren't going to make that much to begin with. Not only that, I'm going to knock on your door. The reason the brokerage firms like you doing all these 90 legs is you're probably not going to lose much, but you're going to do more trades next month. And if you have a 6-leg deal going, there's 6 bid offers that they're going to collect money on. So when they say they're not charging any commission, that's great, but they are working with order flow monies and they're working with bid offers. Okay. So again, be careful if you're doing all these legs, trying to make 50 cents or $1. And then under certain circumstances, you could lose $5 or $10. You're not going to lose $5 and $10 every month, but it's going to happen at some point. And many of you out there have experienced that. And of course, over my career, I've experienced it, so I know firsthand. So my view is if you have risk capital, you obviously want to make some money. I'd like to show you things that you might be able to make that kind of money in. And what's my job is to do all the freaking homework, to make sure we find setups that make sense, that we make sure the options are cheap. So again, our risk on each option is really, fairly reasonable, and that there's a reasonable possibility of catching a ride. I think that's what you're supposed to be doing with risk capital, but that's just my opinion. So anyway, I just gave you 3 things there, and I would like to show you some examples of a reversion and why that is so important. Like I say, Bitcoin, and I didn't get into Bitcoin. I should do it real quick. I don't have forever on this thing. Bitcoin, I always use the 5-year graph, which is the weekly, right? And so bottom line is that, okay, we loved it here at 30 grand. We didn't love it until it pulled back to where? 60 grand. We didn't love it until it went back to 80 grand. We didn't like it until it came back to 100. We didn't like it till it came back to 110. And now, again, as long as it keeps going, that'll be fine. But it's right in that area where it's either going to accelerate or correct, because you see the RSI is at 60, 64, whatever, don't be squeezing the numbers that tight. If it's going to go to 70 or 80, it's going to happen from here. If it's not, it's going to be similar to when the RSI hit 66 here and then pulled back again. Okay. 2 things on the crypto. One is MicroStrategy. This thing has been having a tough time because everyone knows that their premium has gone out the roof, meaning the value of the stock versus what they own in crypto. Now, this thing is on the verge. Because if crypto is going to 200,000, like Tom Lee says, by the end of the year, something wild, this stuff is going to ignore the premium and it could take off. So I'd watch this one like a hawk, because there's not been that many times you get to buy it near its moving averages. And if this thing takes off above 400 or 450, these options here are going to scream. But it's still a big if. So that's a monitor kind of deal. The other thing in the crypto, because like I say, I'll show you some of the ones that have been in my report. These are the ones that have been in my report. You think they've been a good deal? Okay. These are the ones that have been in my report. Okay. But I'm not getting in now. You understand? I'm not chasing, sky high. You're supposed to have gotten into it when it was down here. And if you didn't get in at the right time on things, my advice is don't do it. Another one we had was Riot. Riot's obviously, this is where you want to take your shot, and now you're taking the gravy. Okay. But BMNR is going to be very interesting, because this is the guys with Tom Lee and Peter Thiel as investors, and they're supposedly trying to corner all this stuff on Ethereum to back the stable coins. So if there is one thing that you want to take a bet on, it might be this, because you see all this area up here, that is all going to get filled in if half the story of what Tom Lee is selling is true. And that is that the stable coins are the way for the banks, and that this stuff is going to be the backbone of the blockchain. And that's the story that he's selling. And if you're a buyer, this is the way with limited risk options. And I have, that's been on my report as well. And I actually started doing this at 30. Again, I don't do things up here. When it reverts to the mean, I try to bring the subscribers ideas that make sense. Did it make sense here? You bet. Did it make sense here? So far. Okay. So I'm trying to keep you informed, the subscribers, on a lot of things that are going on.
And
Now I know yeah.
And Jim, real quick before you go on, of course, as a buyer of options, what you want to look out for, and I'm just repeating what I said before, is you want to buy low and sell high. But when our
That's it.
options price is low, well, when the volatility is low and everything is condensed, yeah, you don't want to buy it when everything is screaming up. You want to wait until for that right moment to get these option contracts, as Jim said, dirt cheap. And then, use it as a speculation that if a big move happens, yeah, you have front row seat to this.
I'll give you a little tip. When you do a trade in stock, in real estate, in options, somebody is not very smart because they're going to lose. So when I look at these options, because I've done these for decades, I look at them and say, who's going to be the idiot here, me or them? Now I look at it and I go, well, the seller's getting $1 or the seller's getting $2. The trends are about ready to scream. Is he getting a good deal by taking unlimited risk for $100 or $200? Is that a genius deal when you can see the trends about ready to take off? Or is the buyer getting the good deal by putting up 100 or $200, totally limited risk, and you can get out before it goes to zero? When I get into something and it's not happening, I get out. This idea of I don't want to take a loss, that's another guy's problem. That's not my problem. My idea is what's the net result, and that means you're going to have an inventory of positions, and every day you walk in and you see who's performing and who's not. If they're not performing, and you look at their charts and your information and it's not looking good, get out and rotate your money to the ones that do look good, or keep your antennas up, hopefully by having a subscription to what I do, and see what I've come up with as a new idea that might be good. That's the way you do it. Look at things in life that the other guy, is he getting a good deal, or is he getting a fair deal, or is he getting a silly deal that you're going to be able to take advantage of? And that's what we're trying to do with the calls from the buy side. I'll give you, for instance, this was actually a customer of mine who called, and I was in shock because, again, everyone gets my cell number. So why he didn't call me up before he did something silly like this is beyond me. But he did some selling of naked calls on Oracle. Now, under what circumstances would you ever do that? Right? And then this thing jumped all the way up here. And I was fortunate enough to tell him that it could pull back to 290 because of a short-term thing. So it took about $2,000 off of his loss per contract, but it was just a silly thing to do. This is also a good example of why this thing was having earnings. Okay. Do you think Oracle is going to announce bad earnings when they're in control of all these infrastructure on all these data centers that are like 5 miles long? Do you think they're going to announce bad earnings? Of course not. So that's why this thing was like a high probability that it was going to break out. Now, after it breaks out, reverting to the mean, this is where you take your second shot at 270, and you're already $18 to the good. I'll show you what I'd be cautious on here. This is AMD. The whole world is running in there like they're running out of again. But this thing is very extended. And at some point, it's going to revert to the mean. I don't know when that is because I have no evidence of it. But when it does, that would be the time to maybe take another shot at it. But if you haven't gotten into it yet, it's awfully late in the game to jump in. I did want to do like some of you guys are doing selling of options, right? So I wanted to go over a couple of things real quick here. One is selling credit spreads. Now, again, very popular, iron condors and, butterflies and all that kind of stuff, right? Or, we're going to sell 2 and then we'll buy 2 more out of the money. And you know what I'm trying to say? So the bottom line is what you get in a lot of trouble with those trades at some point, right? And when you do, it's not little trouble, it's big trouble. So I would suggest that you find stocks that are trending and use something like a moving average as a discipline, right? So some stocks that I have put on the alert that have been trending for a long time, one would be Roblox. And as you can see, you could have started out when we talked about it around 50 or 60, just use the blue line and sold the puts credit put spreads all the way up, all the way up. Now, this is months and months of collecting cash. Now, of course, when it breaks, okay, obviously that's when you get out. Now, you could get out at the green line or the blue, but I would keep things on a short leash. Why? Because you don't want to have a big loss. Another thing is a lot of people are very interested in selling very short-term options. And let me tell you the good and bad news of that. The good news is, and let me show you right here. Some guy was selling puts, probably weeklies, right? All the way up. Oh, I'm having a lovely time. I'm having a lovely time. And then all of a sudden it drops $20, $30. That means those options that were going for like $2 are now going for 30. And you know what the problem with a short-term option is? It expires. And when it expires, like say it expired this Friday and the prices are down, you must take a loss because they're going off the board. So they're going to close you out, and it's going to be a debit on your account that's going to be huge. So that's why this activity is very, very comforting, and then it becomes very what? Non-comforting. Another one that I would suggest that we talked about in the alerts was Alibaba. And this thing, come on, it broke out just like we were talking about. It was right on the alert, long-term option. And look, sell puts, sell puts, sell puts, sell puts, sell puts. But now you're up here, and it's a different risk than when you were selling puts down here. So let me give you a couple of examples of what might be reasonable to do at this point, if there's going to be a turn in trend. One is, and has been going pretty good, United Healthcare. I mean, the darn thing went from $600 down to $240. Does that sound like a big drop? Okay. And what are we out of? Nobody's going to need healthcare anymore. So again, nothing goes down forever or up. So here you turned up here. And so in all of August, you kept the premiums. In July, you've kept the premiums. Excuse me, in September, you kept the premiums. In October, you're keeping the premiums. And you've used this moving average as your get out point. That's the way I see it. And where could it be going? It could be going to fill this gap, which means there could be months ahead of writing these puts, just like it was in Roblox and Baba. Another one that I looked at that looked like it could be a reasonable situation is a Molina. Does that look like you could sell puts, maybe be okay on it? It's possible. Now the other one I was talking about is covered call writing, and covered call writing, in my view, is pretty simple. You're going to be selling a call, so you're making an agreement to sell your stock, which means they're going to pay you money because you've agreed to sell your stock. So when would you want to sell your stock? How about when it's way up in price? Like this guy here. Okay, let's say you bought it for $50 or you bought it for $100 and you're way up here. Now, what I like to do as a general rule is go 10 or 15% out of the money. So let's go look at what that would be. If you went to November, I think I even looked at December. Hold on. No, November. So say you thought it was at a short-term peak and you went to November and you sold the 165 or the 170 calls. Well, it's at 150. You're agreeing to sell it at 165 and you're getting another $10, which means you're really agreeing to sell it at around 175, which is $25 higher than it is. And it's already gone up 50, $100, right? So that is a pretty healthy premium. If you want to go 15% out of the money, what do we got there? 150 times 15%. What would your strike be there? Your strike would be 150 times 15%, 175. Well, 175, you still get $650. That means you get another 15% upside potential, and they're giving you $650. Now, I'll give you a little quick tip here. What you could do if you want to protect your equity because you think it could be vulnerable in the next 2 months, well, you could take that premium. Remember, you sold the call. Let's say you sold the 170s or the 165s. You're bringing in about $8 or $9. You take that money. Now, don't forget, you got a ceiling now at 165 or 170. You've capped it, right? You've capped your gain up to that level. That's still, again, 10% above where you are. But you take that money and you buy a put at 140. You see the 140 puts? So you've sold a call, would put a ceiling on your equity, and then you took a put and you put a floor on your equity. So now you walk around town until November 21, knowing that your hood can go up to 165, 170, whichever one you choose, and you're still making money up to that point, plus the premium. And you're walking around knowing you've got a floor on your equity at 140 until November 21. And, that's not the only stock in the world right now to consider looking at that. Just to give you an idea, the ones that have been in crypto, right? The ones that have been in nuclear, the ones that have been in nuclear, the ones that have been in quantum, right? These would be the candidates to start pricing out some things, right? Because this thing went to 50 almost, and it used to be $15. So again, when the markets are like this, there's a lot of alternatives. And again, one of the benefits of being a subscriber is that everyone gets my cell phone to text me. And so obviously we do coaching where we can go through some of these things, maybe before they become problematic.
Great. Yeah, thanks, Jim. That's awesome. We're gonna get, I see many questions coming in. We're gonna address all these questions, guys, but I want to quickly grab the screen back
Oh,
because I want
sure.
to show you something else, and then we're gonna get back to the charts, I promise you. So I'm gonna share my screen again. All right. So, because next on, I want to afford everyone in the room, and I also want to be respectful of the time that everybody, is spending this evening. I want to afford everyone a free options idea right now from the desk of the option professor from Jim. So, and all you need to do, if you want to, get a taste of what Jim has to offer, all you need to do for this is to send him a text message right now. So if you're in the US or Canada, all you need to dial is this regular number. If you are abroad, make sure you dial the country code +1 also. And all you need to do is to say something like this. Say, hey, Jim, this is John, Daniel, whoever you are. I joined your options webinar. Could you send me an option trade idea tomorrow? So this is the number. I'm also going to put this number into the chat for a free option idea tomorrow delivered to yourself. And of course, we promise you we're not going to use your cell phone for any, I'm not going to sell it away. So don't worry about this. So this is Jim's personal phone number, by the way.
And
So
don't sell mine away either.
yeah, exactly. So I'm going to put this into the chat box right now. And Jim, maybe just elaborate real quick on this while I'm putting this number in.
I have to
Okay.
stop sharing it. Oh, okay. So anyway, yeah, you guys, this is how we do it. You text me at the number, and then I respond to it. Like I say, just to be clear, I don't give advice out to anyone, nor do I recommend anything to anyone. This is all informational purposes only. But obviously, I have plenty of things that I follow, so I'm sharing information. But again, yeah, just ask me, what you'd like to see, and then basically I will send something over to you. We've got stuff coming up, guys, that's very exciting. You have got a situation where we've got the banks coming out with earnings next week, and they're on the defensive right now. Is there an opportunity there? Maybe. We also have IWM, the small caps that are taking off. There's a couple of stocks that have not moved yet. Some of them have gone through the roof already. You can't get into them. But there are a handful here that I've noticed that are in the small cap index. And of course, Tom Lee and people like that, they're all into banks and the small caps. I mean, they think these are the cat's meow looking forward. Whether they're going to be accurate or not, I don't know. But I'm certainly putting them into my research to see if there's anything there. But yeah, so there's some good stuff coming up here very soon. Not to mention, like I say, I'm following this market very carefully. It to me, like I told you, it's on a ledge from the standpoint of the market breadth and the McClellan oscillator, and so. And the trend is up, and the negativity is still pretty much out there. So it's possible it's going to 68 to 7,800 to 7,000 on this run, and maybe the run just keeps going into January for all we know. I suspect that there could be a bump in the road a little bit later in the month of October if this thing keeps running at this pace. And then any of those factors I talked to you about, meaning inflation, job losses, higher yields, stronger dollar, if any of that stuff, were to get going. Argentina is having a currency crisis over there, and according to Besant, we're supposed to be supporting them. Is that an incident that could cause disruption? And of course, in Europe, you've got all kinds of problems with the prime minister. And in Japan, you got a lady coming in who supposedly likes to print money. So there are things going on that could upset the apple cart. But right now, obviously, between gold and Bitcoin and stocks, it's just melt up time. But
Yeah, that's
we'll have
right.
to see.
Lots of things are going on, and in fact, there was never a better time for getting into options. So if you want to
Sure.
take it to the next level, besides getting this one trade idea from Jim, which is completely free, what we also do offer, and Jim mentioned this a couple of times, we do offer what we call an options idea alert service, which will get you every single Sunday, like clockwork, like clockwork, our options newsletter into your mailbox per email, and in there you will get trade ideas, many trade ideas served on a silver platter. And not just the idea, it comes with all the details. What is the underlying? What is the expiration date? What are the strike prices if it's a multi-leg strategy? So everything you need to know and everything which is so crucial for trading options properly are in this newsletter. So we call this the options triple play alerts. And currently it consists of short-term strangle ideas, which are buying. It's a it's a buy option play, which will make money if volatility picks up, regardless of where the underlying goes, up or down. It's a non-directional play. You can benefit from these strangles if the underlying moves up or down. You also get our index swing trade ideas, which looks at the major indices, the SPX, the SPY, the NASDAQ, the Russell. And you will get our medium to long-term directional plays, which are longer-term plays with longer expiration dates, which are more on the speculative side of things. But if they work out, of course, there's a lot of potential there. And if you want to take advantage of this, all you need to do, and there will be a special offer coming up in a second, is to go to tradingindicators.com/alerts. I'm going to paste this link also into the chat box right now. All right, just to give you some ideas of what you can expect if you were interested in this. First off, you get our newsletter every single Sunday, written by the option professor himself. Our newsletter with a global market overview, some outlook of what may come next, and most importantly, with very concrete option trades. These are all handpicked by Jim himself. So when it comes to strangles, for example, this is an example from our latest newsletter, which went out on Sunday around 6 p.m. Eastern time. These are some of the ideas that we picked. And you can see them here. Everything laid out. The underlying, the expiration, the strike prices, and what the approximate cost of this whole thing is. And the idea of these strangles is that you want to grow a small amount into a big one. Meaning you risk a little amount, sometimes $135, sometimes $327, sometimes $290 in the anticipation, okay, potentially this can grow into a much bigger amount. That's the idea of these short-term strangles, which are all laid out. We also include the sector because, with anything in trading and investments, you want to diversify. You don't want to put all your eggs into, one basket. Yeah, perhaps pick the sector that you like. Maybe you pick one idea in that sector, then go to a different sector. Spread it out a little bit. This is all laid out for you right here. And here's some examples, and Jim, perhaps comment on this, of what we have posted and how it resulted afterwards in our newsletter.
Well, you can see from the expiration dates, they all pretty much expired June, July, September, October. And obviously the Octobers haven't expired yet. And then on the left-hand side, it tells you what date it was on the alert. So basically, obviously this is just a group. We have many, many more. Now, they all don't work this well, but the idea is the ones that don't work well, we have a limited risk, and the ones that do have a good potential. So here, just explaining it, on August 24th, which is 6 weeks ago or something like that, we talked about an idea on Baidu. $100 call and 75 put. Now, let me explain something. You can buy both of them right away, but you can also just buy the call first. And then if you need the put, buy it later. But if you bought them both together, it's 255. If you didn't buy the put, it might have been 250 or something like that. But at any rate, you're getting a limited risk call expiring October 17th. What happened to Baidu? It went to at least 138. So what's the difference between 138 and 100? 3,800. That means your 255 jumped up to 3,800, which means you had plenty of time to take a gain on this. And if you held it to the maximum that it went to before expiration, which as far as I wrote this up was 138, that's the most it could have been worth. But it still went from 255 to 500 to 750 to 1,200 to 14. You understand what I'm saying? Same thing with Cloudflare, Google. 3 times I did Google. Why is that? Because I could see what's breaking out. So every week, the 10th, the 17th, the 24th, it was on there. And we're putting up like $300. And when Google jumps to 253, you're getting a nice pop on it. There's your Roblox from earlier in the year. There's your Blackstone, had a nice big move to 173. It's not at 173 any longer, but it was, during this period. Datadog had a big jump up to 157. AbbVie is a drug company, and believe me, if you guys sign up, you'll be hearing about drug companies now because a lot of those are making a turn, as you saw with United Healthcare and Molina. So again, that's where the value might be looking forward in your healthcare, in your financials, in your energy, in your transportations. We're not going to chase the moon here and find out we're giving liquidity to the smart people. We're trying to find things that are inexpensive where it can grow to expensive. Teradyne was a great move for us. It even went way higher than 124. And you know what's good about this? Look at those stocks. How many of those stocks were in your portfolio during that period? Not many. So what is the purpose of having a subscription? I'm bringing things to you that you would not be aware of. You can do many things with these things. You could change the strike prices. You could just buy the stock. You could do anything you'd like with them. But you know what? Maybe nobody told you to get involved with Robinhood at 60 on April 27. Maybe nobody told you to get involved with Teradyne or Microchip. And that's the value here. And it's really peanuts that you have to pay for this. I mean, I know what's going on out there as far as all these different services. This is just ridiculously reasonable. Yeah. And it comes with being able to text me if you have a question on something. I mean, that's a pretty good deal. But again, do you have any others here? Yeah, you got to look at, there's some more. There's some more, and they're all over the board as far as what the companies are. Unity Healthcare, Unity Software, Quantum Computing. There you go. How far did that go past 22? I don't even know. There's IRN, and the price went, look, we were in this thing at $8. It was on the thing. You can keep trading it after it expires. If you see it keeps going, the thing went to 56. So there's definitely good information on there. It's not all perfect, but I've been doing it a long time, and I take extremely large pride in trying to help you guys, along your journey here. And that's the goal.
And Jim, what I want to mention also is you spent the weekend basically researching all these opportunities, basically options which are currently underpriced, which are affordable, and it can be sometimes as low as less than $199.
Yeah, look at Open Door. Look at Open Door. It's still alive. It's not even dead yet, Open Door. And I got it at 11. I don't even know what it's at now, but I think it's higher than 11. And it's still available. It's still what they call not expired yet.
And this is what we mean by growing a small amount, taking minimal risk, as little as in this case, $85 per trade for both legs of the option contracts.
And this is a good example. You think I really wanted to buy the $1 put? You just buy the $2 call. But since this is a strangle, I represent it as both.
Yeah.
But it wouldn't matter. At $85, who cares what you did, right?
And by the way, if you don't know what a strangle is, this is where our options masterclass comes in, which you will get completely complimentary. So let me actually move forward to that part where we're going to show you how to take advantage of our options alert service. Well, here it goes. And there will be a special offer coming as well. First off, there are 2 ways to get involved, either through a quarterly subscription or through a yearly subscription. Let me quickly start with the quarterly one first. First off, it is normally at $397 a quarter. But if you sign up today, you will get it for only $2.97 a quarter, and this is grandfathered in. But this doesn't stop there, because you will also get our 6 hours options master class, which will bring you up to speed and which will teach you everything you need to know to take full advantage of these options alert service. And now the kicker. This will come with 1 hour of personal one-on-one coaching with Jim, the option professor. And in those coaching sessions, you can discuss anything, your current portfolio, how to hedge against risk, about open positions, and so on and so on. You can pick Jim's brain in these coaching sessions. So for only $297 for the quarter. But the real value comes in when the yearly subscription is chosen. This one normally costs $9.97 a year. If you take advantage today, it's only going to be $8.97 for the year, grandfathered in. This one also comes with our 6 hours options masterclass and 4 hours of personal one-on-one coaching, which you can spread out. You don't have to take it all in one shot. I guess that would be too long, 4 hours. You can spread out over the year. And here the kicker. If you sign up today, we will give you an even better offer, an additional 1 hour of personal coaching if you choose the yearly option. And all you need to do is to go to tradingindicators.com/alerts to pick any of these two subscriptions, but of course the yearly one will give you the best value for your money. So I'm going to paste this one into the chat, and Jim, please elaborate just a little bit more about what these two options are.
Sure. Well, again, many people have tried it, different things all over the place. So they're, tentative or whatever. So that's the only reason we could put the 297 out there. Again, if you wanted to just be trying it, if you're serious about trying to make some money, you just only saw 90 days of ideas. Imagine getting a whole year of ideas. Now, the other thing is that, perspective. At 897, it comes down to a little bit over $15 a week. I went out with my son. I bought him a Philly cheesesteak, and it was like $20. So you can kill two birds with one stone here. You don't eat one of those sandwiches a week, which means you're going to be healthier, and you get ideas for the whole year. So putting it in perspective, it's an extremely low amount of money for what you're getting. And the kicker is, obviously, you can text me and we can work some questions out, and you'll be doing a lot of different trades, not even my ideas. And you may want to talk to somebody who actually knows you, who actually can speak to you as somebody who's aware of your, what you're asking and all that. And that's, I think, quite a bit of value, because like I say, I've traded thousands and thousands and thousands of options, and I still trade options all the time. So, I'm here to help. Everything Daniel and I try to do is try to help you guys become better traders, hopefully make the path you're following a little smoother. And so, I do encourage you to get started, because, we're going right into the earnings season and the end of the year. For gosh sake, I mean, could there be a better time to get started?
Yeah, exactly. And I think, yeah, absolutely agree. This is a great service. It's been out there for more than a year now. We got great feedback, great trades for our service. So yeah, guys, great offer today at tradingindicators.com/alerts. Now, let's talk a little bit about some questions that came in. And somebody's asking, the website does not show the discount. Is this applied later? It should be showing the discount.
It's always in the bottom on the right-hand side. So that's the confusing part. If you go back to where it says complete purchase, and then you look on the right-hand side, you'll see the correct number.
Yeah, let me actually go there real quick. I'm going to open up this page right now just to make sure I didn't make a mistake here. But of course, if there was a mistake, of course, we would refund you that extra money paid. So that's no problem. So this is the page here, the offer page. You scroll down a little bit and you see, yes, I want option alerts now.
Mm-hmm.
If you do, you will now see here, yeah, the discounted one for the yearly, for example,
Yeah.
at $8.97. This is what you want to look for. This is the regular price, but you will get the discounted version, either $2.97 or $8.97 for the yearly. All right, perfect. Okay, so now I wanted to quickly look at some questions that came in. And Jim, you were a professional options seller when you were working at institutionally, and there's a question here for option selling. So if you sell options, how far out of the money you typically typically go like a delta 30 or delta 40? What's your sweet spot there, or don't you have a sweet spot? You
I
base
really don't have a sweet spot because I think I have to look at everything on its own merit. So I'd have to look at the stock you're looking at doing. I'd have to look at the moving averages, where they are in relation to the stock. Does the stock have earnings coming out that could be very disruptive? Is the market overall in a disruptive or in a trending situation? And then, of course, I need to look at the prices. But I like to get pretty far away from the money, so I don't go very close to the money. I'd rather be further away. And so if that means adding another month of time, so be it. Because the key to making money when you're writing the options are two things have to happen. One, is going to happen, right? Time's going to go by. And the second thing that has to happen is it has to stay out of the money. So based on those two things, that's what I use as my gauge. Those who get into a robotic selling structure, they may do very well for 8 out of 10 times. The other 2 times, if they don't, have the humility to get out when it's going wrong, or if the market just goes and gaps on you, that's going to be real problematic. So when I'm doing the writing thing, I kind of like on the one with Hood on Robinhood, I thought it was reasonable to go out to the November 21st. That's pretty close to the time running out, but the premiums are still very healthy. And again, I want to give it, like on a covered call, I want to give it 15, maybe 20% above in some cases like this, where I'm not going to cut myself short and I still get well paid.
Yeah, exactly. Perfect. Another question from Bill that came in. Bill, thanks for your question. His question is, Daniel or Jim, do you use liquidity zones or support and resistance levels to find your option trades? I think here the answer is very straightforward. Absolutely. Jim, you always look at support and resistance where things may bounce off from, correct?
Oh, no doubt.
Yeah, absolutely. Yeah, Bill, 100%. Okay, perfect. So, Jim, why don't we look at some more charts to see what else can we see in the market?
Okay,
Yeah,
hold on a second here. Let
yeah.
me share a
And then
screen.
we're gonna bring the offer back on after.
Yeah, because I did want to talk about the banks and the small caps, because according to some sharp people, they're supposed to be the cat's meow looking forward. Why the banks? Because they're going to use all this AI to fire all their people. And they're going to be very profitable. So good news for the shareholders and good news for the accountants. Not so good news for the grunts. We've seen that movie before, right? So anyway, let's see what's going on. People are thinking that these banks are going to be making a lot more money in the future, and their PE ratios are going to be much higher than they are. If that's the case, obviously it's a really green light thing. Now you've had a reversion here on JP. So you can see here, if this door doesn't hold, the next door down is way here. Okay, so, and again, you saw on the 10-year note, if that 10-year note started going 430, 450, and there was a little change in, Jamie Dimon was on TV. He said clearly, the two big risks to our business is going to be if inflation takes off and the job market gets bad. Both of those are going to be very problematic for us. I don't know if it's going to happen in 2026, but if it does, they're going to deal with it. So, he knows there's risks in his business, but he also knows that things are going well. So they're going to be announcing earnings on the 14th, and I would imagine their earnings are going to be quite good. Citigroup is another one. So all the majors, again, they're all looking on the defensive, though. And that RSI doesn't look very good. But you know what? If they announce good earnings, it could pop. And again, it is stopping against the former highs. So this is a neighborhood where this could be a reversion. You start blowing out 95 and going down, it's beyond reversion at that point. Same things with Wells Fargo. So these are the ones I'm keeping an eye on because they're being discounted here. It used to be 87 bucks a share. Now it's at 79. That's 10% off. Another one, of course, that I've worked with in the past, had success with, is Bank of New York. Again, reversion to the mean or end of story. We're going to find out pretty soon. And then, of course, you've got smaller banks, TFC. And this one's interesting to me because it's a small cap bank. But if I look at the 5-year graph and I show you the 5-year graph, this thing is a small, this is a regional bank. Does that look like a reverse head and shoulders to you? So if in fact this thing could get above, then this is I would wait for this to see if this thing can get above the number there, which is around 47. There's nothing but open land here. So keep an eye on this one because now, like I say, it also is looking like it's rolling over. That's why I'm concerned about people who think rates are going to go lower, credit spreads are going to stay tight, because the banks are not really acting that way. Now let's turn over to IWM, which is your what? Which is your small cap. Now a lot of these stocks have taken off, like you know what. They're the ones I'm not that concerned about, but there were a few that look pretty good. This one looks like it's trying to break out. And this is a big stock for them. And this is HIMS. So you can see if it can get going here, it's trying to turn up. And you see when these two guys get together and go up, that's a good sign. So if it gets choppy here, don't abandon it, because if it starts closing above 60, it looks like it could fly. And that's a pretty popular one. CRDO, another one where you've come down to the mean, and if it can start breaking above 150, again, that could be a good situation. You can see in the aftermarket, it's at 150. These are all good-sized companies that are, big parts of the IWM a little bit. And the last one on that IWM that hasn't taken off yet, Fabrinet, and that looks like it's on the verge too. So they give you 3 ideas right there on those. And then I'm really big on some of these, what do you call it, pharmas. If you look at the longer-term graph on Amgen, right down there to its 280, and you can see it's held, and now it's on the upswing. Okay, looks like it's really ready to go. These things have not happened yet, and that makes it cheaper to buy into and a lot more profitable if you're right. There's your Viking. Viking looks like it's getting ready to go someplace, and there it is, but it has some resistance right here, but it has a gap to 40. But this is a more of a biotechy thing that could have some good future to it as well. And then I was looking at Bristol Myers, because I thought that looked like a tapped out company. As you can see, this is a 1-year graph down here, but I looked at the longer term graphs. You see how it's on the gold line down here? So I don't know if it's going to hold 45 bucks or get above 45 bucks. There's a lot of, resistance here. But if these, I'm talking about over the next 90 days, if people start rotating out of some of this stuff that's way up and want to buy stuff that's a little bit more defensive, healthcare and banks are definitely more defensive. And of course, if rates are going to drop, that IWM is supposed to benefit quite a bit. Is there any other stocks anyone would like me to take a quick look at that you own now, or?
I don't see any stocks, but we do have some questions here. One
Let me show
question.
let me show one last one
Okay.
quick too, because this one just and they have earnings coming out, and this could be going someplace. It's JB Hunt. You see on the long-term graph, it hit the purple, right? Now look at the short-term graph. Looks like it wants to go somewhere.
Yeah.
Okay. So
Cool.
yeah.
Patrick had a question. He says, Jim, is it true that trading has become like almost like mathematics to you, where you just look at the hard facts, or is there, how much of an art is there when it comes to picking these alerts?
Well, I think, there is an art to it, because I'm interpreting the moving average and as it relates to relative strength, and I'm interpreting what's going on with the Fed and what the interest rate's going to do, and if these tariffs are going to be a problem, and, is unemployment going to start spiking? So, yeah, it's not just look at the thing and forget about everything else, but clearly you're following the price. Options are 2 things, like Daniel was saying, it's price and time, right?
Yeah.
Time's definitely going to go by. So that's a definite. And so the price is very important. And that's why I really focus on the charts as far as that's concerned. But, transports or health, things that are way out of favor. Tom Lee was even talking about this, sentiment. If sentiment is extremely negative on something, then you've got to figure out that most people who want to get out of it are out of it. And therefore, the most logical thing is that whatever brought it down, they're working on changing those circumstances. So that's why, a company like Chipotle, okay, people still eat there, and they're going international, and they haven't been international. So that could be a very big change here. And when I look at a 20-year graph on Chipotle, I can see that the blue line is still rising. So this could just be a baloney move here if it gets back above what? 47 bucks. And the 5-year graph is telling me that it's right against yellow. And this thing used to be 70 bucks, and I'm looking at it at 40. And this is not a lousy company that people don't like. And even on the 1-year graph, it is trying to turn up. So, and look at the gap there. Now, these options don't cost dirt. So if in fact you were going to get a run between now and Christmas because people start eating out at Chipotle or whatever, or they announce that they've just opened 50 Chipotles in Paris or whatever, that could be a change in the game. And again, what have people that are selling, what have they not factored in? They haven't factored in that this company's probably out there trying to change things to make it go back up.
We do have a symbol request RY from Paul. RY, what is this?
I know Restoration Hardware. Oh, Royal Bank of Canada.
Oh.
Well, let's salute them then. They're royal. Well, here's the deal. The way I look at things is I look at the 20-year graph and I can see it's very overbought. And I look at the 5-year graph and I can see it's overbought. And I can see the RSI is kind of not doing the greatest right now. Then I look at the 1-year graph and I can see it's on the ledge. So what's the good news here? It had a reversion to the mean. The bad news is it has a gap down there that might want to get filled. The RSI looks like it's losing steam, like a plane that's descending. But if it started to break back above and stay above 147, I'd be interested in the long side because this might just be a pullback. But if it starts consistently staying underneath 147, and let's look at the shorter term now. This is a 2-hour graph. You see, if it gets back above 146, 147, can you see why I'd be back on the train? But right now, you're catching a falling knife. And if I look at the 30-minute graph, same story. Now, again, I look at the RSI at 28. I look at the RSI at what? 35. That's a divergence. What would be the bet? The bet that is the selling is drying up and it's going to pop back up.
Great. Here's a more of a conceptual question from Kenneth. How much of gamma exposure factors do you consider in your strategies? Meaning, how much, where are like the option trades? What's the most volume trade? What's the most interest right now on these contracts? Does this make a is this a criteria in your decision making?
Well, I mean, I don't like to do strategies on stocks that don't have any volume, and so basically, and sometimes I'll become aware of a high volume situation. I'm going to give you an example of that real quick. If you give me 1 second to look it up here. Well, let me see here. Well, okay, yeah, I think I got it. I got it here now.
And let me look.
Yeah, let's look at TLT. Look at TLT here, and you can see it might be trying to break out to the upside a little bit here. And so if I go look at the option prices, and I go look at the November 92 calls, and I see an inordinate number of calls. You see, that's the volume today. 19,000 people bought this option, or not bought, but traded the option. That's pretty big volume, isn't it? So somebody's making a bet here that between now and November 21st, you're going to get, and other people are making bets at 90 for $1.29. And a lot of people are trading so there's a lot of bets going on here that the yield, because these are calls, and TLT is the 20-year treasury, and it will rise if rates drop. So obviously people are thinking that the yields will break that 4% level, that 10-year, and that this will run up in price. And if, like I say, you did the 190 call here with the 2,500 volume and you paid $130, if it went up $10, you can see it can go from 129 all the way up to $980. So they're not doing it for the exercise of it. They think they're going to be able to make a buck. And like I say, if you go back to the chart, is it possible you could get a pretty substantial move on it? Let's see. If we go back to a 5-year graph, I mean, this thing could go up to 110 if it got going. So is this a rainmaker? Possibly. It could be a rainmaker. So that would be an example of how I have noticed volume being very big. And again, who wouldn't want to bet $130 on something that has 2 months to go almost? And what, it's if it breaks up, you can see if it breaks above purple here, there's nothing holding it back.
Yeah, absolutely. Great. All right, Jim, well, thank you so much for this. I'm going to take the screen back one more time real quick.
Sure.
All right, there we go. And just to remind everyone, for those of you who already came on board, welcome to our community. It's great to have you. You should already have received our welcome email by now. And for those of you who are still thinking, we do have this special offer going on right now where you will get the quarterly subscription at a $100 discount and also the yearly subscription at a $100 discount. And if you go for the yearly option, you will get one additional coaching hour with Jim, the option professor. And I believe it was quite evident what he has to offer, his wealth of knowledge, and yeah, which we would
Well,
like to share with you.
the
Yep.
teaching and the coaching is very important that, that we both, when we're talking to each other, that we find out what your level of options is, and we start there, and then we gradually build like building blocks, because it is a step-by-step process to get knowledgeable in options. It's not a one-day thing. So it's this thing where we build on it every time we have a little coaching session. Then, you can kind of get a better idea. And so we go at the exact pace of the person. If you've been trading a lot, some of my techniques of getting in and out of them might be very helpful, or some of my techniques of how to protect gains or reduce risk when you actually catch a winner. That these things could be very valuable to you if you're not using them now, at least as an alternative to what you do now, because the more alternatives you have, you could maybe pick the best one for the right circumstance.
Yeah. And Jim, maybe give an example of how somebody could contact you once you're a subscriber, how easy it is to set up these coaching sessions. How does this
Well,
normally work?
yeah, like I say, it couldn't get easier. You text me on the cell phone number that we've apparently made globally available. and and you basically ask me when you would like, not ask me, you tell me when you would like to have the session, and then I come back to you and confirm, or we might adjust the time as our schedules permit. So basically it's as easy as sending a text.
Perfect. Yeah. And you can also split, as I mentioned before, these coaching hours across the board. So maybe you want to use 30 minutes today and then maybe another 30 minutes 2 weeks from now. That's also a possibility. You don't need to use these in one block, which
No,
I
and that
believe.
would be the smartest thing to do. And 100% of the people do piecemeal it out.
Exactly. And Yehua wants to know, do I also receive the trading ideas from the option alert service? Yes, absolutely. So these are all about the option ideas that you will get every single Sunday in the afternoon. These are, of course, both included in the quarterly subscription and the yearly subscription. Absolutely, you are. You will get them. So it's not just the coaching, it's actually the ideas which you subscribe to. These are the bonuses that you get. That's why I believe in my mind it makes this such a no-brainer offer to jump on any of these services because you get all this extra coaching and the options masterclass.
Yeah, the three things that seem like the biggest challenges to both newcomers and experienced options people is how much time they can use to do actual business. And the second thing is how to choose which option, which strike, which expiration. And then, of course, after they're into something, how they're going to find out when they're going to sell or when they could sell. And these are three major issues that really, really hurt people. And so I try to help you with each one of these. And again, texting me and talking to me and cutting through, like, even like, well, Jim, what ideas have you been focused on lately? That can, if you're having a hard time, going through the information, it's not unreasonable to, to have a conversation like that to see what current ones, because, like anything else, I'm moving around, I'm doing this, I'm trading that. So these are not stagnant ideas forever. And there's new ideas that can come up during the week. So the bottom line is that, if you're having trouble when you're trading because you don't have the time to do it, we can cut that down by speaking to me about some of the stuff that I think. And of course, if you can't look at it every day, why not do a longer term option on these things? We did Oracle at 160 and 230. We did applied material at much lower levels. That big sell off in May, we were talking about doing December options in May on things like Broadcom, Taiwan Semi. So, you can kind of tailor your option trading around your ability to trade, because not everybody's going to stare at the screen until their eyes pop out. Some people are going to want to say, okay, I'll take some longer term positions in lieu of buying the stock. It's called a replacement trade, because these options only cost a certain amount of money. To buy the 100 shares obviously cost a lot more money. So some people set up a portfolio of stocks based on what? Limited risk options. And we do vertical call spreads, which again, I can explain in detail, which allows you to get involved in options that are expensive because you're writing an option to help pay for the one you're buying. It's not it can be very much explained to you simply, again, once you have a subscription and once you obviously text me and we have a conversation.
That's a great segue, Jim. Yehua is asking, so what kind of strategies do you cover in your option alert service? Well, we have the strangles, of course. Then we have, as Jim said, the debit spreads, which are typically longer term plays. And then something that we're going to add to our service, probably as of this Sunday, are credit spreads as well. So all these different strategies, buying options, but also some selling option strategies will be covered in our service.
And I'm very familiar with all the strategies because, like I say, I've done this for business for decades. So, whatever strategy you're looking at, if you'd like my opinion or my view on it, I'm certainly going to make myself available for you. And again, some of these multi-leg strategies, before you do them, if you speak to me, we'll walk you through slowly what actually you're doing. And secondarily, we'll look at the chart and maybe try to come up with a concept of what the probability is that you might either A, be successful, or B, may have a very significant risk that you didn't recognize. So when you're doing these things at all these other companies with the multi-legs, and you want to have an what they call a outside opinion from somebody who's done a lot of options and has no vested interest in telling you anything other than his true opinion, then you would be able to speak to me about that as well. So that's a very big bonus as well, because a lot of you guys are getting information from a lot of sources, and a lot of people are running around selling bologna sandwiches as filet mignon. So I could be a good sounding board to verify what you're listening to.
Yeah, absolutely. All right. So, yeah, there's another question by Sharon. No, it's not just plain calls. In fact, most of the strategies that we offer in the option idea service are multi-leg strategies, but wisely chosen. Like for the strangles, where you buy a call and you buy a put, which is a non-directional play. As long as the stock moves, you will benefit. So this would be a multi-leg strategy. Also, our debit spreads are multi-leg, and the newly added credit spreads, which will come on the Sunday, will also be a two-legged strategy, Sharon. Yeah. All right, great. Well, I do see some orders coming in, which is awesome. Now, thank you guys so much. Welcome on board for everyone who came on. And I can see you guys picked the yearly option. Yeah, in my opinion, the best value for your money. All right. Let me see if there are some other questions coming in. Oh, great question, Sharon. If you start quarterly, can you later on update to yearly? Yes, that's possible. So let's say you start quarterly, you look at some of the alerts, you like what you see, which is, I believe, will happen. You can then send me an email or Jim an email. Hey, upgrade me to the yearly option, and we prorate you what you've already paid to extend your yearly option. That's absolutely no problem. Yes, perfect. All right. This seems to be all answered. Thank you guys so much for your attention. And if there were any questions which were not answered today, maybe I overlooked them. I tried my best to answer all the questions by writing. You can always reach out to us via our homepage at tradingindicators.com. Go to the support section, click on contact, put your question into the contact form, and I will answer every single question personally. And of course, if needed, I will also involve Jim, the option professor, in this question. And we're both going to do our best to answer all the questions that you may have. All right, Jim, this is it from my side. Do you want to say some last words for this presentation?
I just wanted to say thank you very much, everybody, for coming tonight. And I would leave with you that if you know anyone who's trading options or anyone who would like to learn about trading options, no matter what age they are, they could use this as an educational vehicle. In other words, the master class, you don't have to be a trader right now to benefit from it. But it's an educational thing that could be quite good. And even if somebody didn't have quite enough capital to do much trading with their risk capital, they could do paper trading and learn quite a bit from what we offer and do practicing with paper trading until they have either the proper circumstances or whatever. And so, anyone who is either trading now or would like to learn about trading, you should allow them, to know about this offer, because this is a very, very reasonable amount of money for what you get.
Yes, absolutely, especially with the free coaching. And I always think either you do something completely committed or you don't do it at all. And I think the yearly option would show your commitment. And of course, you will also get our commitment from our side, including all the training and coaching that you will need to get fully up to speed. All right. So with this, guys, I wish you all a great evening or a great morning if you're calling in from Australia. It's been fun. Jim, thank you so much for being on this call. And yeah, talk to you guys soon. We'll be next up at our lunch and learn session at 11 a.m. on Monday. And actually, I forgot to mention, everybody who signs up will also be invited to our weekly exclusive webinars with Jim, the option professor, where we review the market, look at some interesting ideas. And if you come on board, you will also be part of this community. Our weekly webinars, the next one will take place this Monday at 11 a.m. Eastern time. Of course, these are all recorded. So if you miss it, you can always watch the recording afterwards. With this, guys, thank you so much for being here. It's been fun and talk to you soon. Trade safe. Bye-bye.